MCX IPF presents Commodities Trade.
When it comes to supply and demand fundamentals in the world of commodities, one of the most significant factors is the cost of production. If the market prices of a raw material is higher than its cost of extracting it from the crust of the earth and any other form of production, it leads to increased output. When the cost of production is higher than the market price, output declines as it becomes a losing proposition. The price cycle in commodity causes prices to rise to levels where production increases. Higher output leads to growing inventories as a market becomes more expensive. The elasticity of demand causes consumers to look for substitutes and buying declines, leading to price stops and reversals in the downside. That is all economics. I want to put forth on what the cost of production for some raw materials is right now and where the prices stand as the recovery in demand, high stimulus and speculative activity have led the prices to. In crude oil markets, output costs vary according to the production location. Saudi Arabia, Russia and the United States are three leading oil-producing nations in the world, and each has a different sensitivity to output costs. The cost of production for oil in Middle East may be lower than US and Canada, but their economies depend on oil revenues, thus the need for higher crude prices. So you have a cost of production for major producers. The cost of production at Saudi may be at $9 a barrel, but they need the selling price to be $65 for their budgeting. The iron ore prices hit all-time highs above $200 a ton in the month of May on strong demand for steel raw material, especially from China as it needs imports as their cost of production is non-profitable. According to a report from Bloomberg, around 70% of the China iron ore output is uneconomical, below the level of $96 a ton. It's not just about pulling metal out of the ground. There are costs associated with discovering the mineable deposits, conduct exploratory drilling, and then extensive geochemical analysis, buying the license to mine, meet all environmental regulations, spend on the right equipment, and then there is mining duty and royalty to look at as well. And this is what comprises all-in sustaining costs. And those are the commodity prices and cost of production. Most of the commodity prices have surged between 10 to 80% in last 12 months, making it profitable for the miners, but expensive for the downstream companies and the end consumer.
MCX IPF presents Commodities Trade.
Brought to you by MCX IPF.